Please tell us a little bit about Merchants.
Yeah, the Merchants Investment Trust is a UK equity investment trust, a closed-end company. It's been going for 126 years, and the objectives of Merchants are to deliver both a high and rising dividend every year, along with good total return, good capital return from the portfolio.
Have you made any changes to the portfolio as a result of the recent volatility?
We've looked to take advantage of the recent volatility where possible by adding to holdings that we like, companies we like, when they're weak, and potentially taking some profits on companies that have held up better where the valuations are less attractive and reinvesting that elsewhere. Yeah.
What do divergent global interest rates mean for the UK equity markets? And do you think the Bank of England will follow the Fed or the ECB?
Yeah, that's a good question. I think the UK has historically been closer in terms of the economy to the performance of the US. You know, our growth turned around at a similar time. Unemployment's been falling in a similar manner. The thing that complicates the comparison this year is the risks around Brexit referendum and the uncertainty that is producing at the moment and may continue to produce up until the referendum and even beyond it. And any effects that might have on economic growth could keep the Bank of England from raising interest rates in a way that you might normally expect. So I would expect overall the UK to be closer to America in starting to raise interest rates, you know, earlier than the European Central Bank. But I think the Brexit referendum will keep them on hold for a bit longer.
How do you expect the Brexit debate to impact the Merchants Trust portfolio?
There's been a lot of focus recently on what Brexit referendum may do in terms of economic uncertainty in the UK and potentially impact on the UK economy. One of the issues that's not that well understood, or one of the factors, is that actually if you look at the big companies in the UK, the FTSE 100 companies, they're typically dominated by international earnings, overseas operations, and they're less impacted, in fact modestly impacted, by any risks to the UK domestic economy. I think where there's more likely to be an impact is in the mid-cap FTSE 250 type companies, which are a smaller part of the portfolio. And there, if you see a genuine upset to economic growth and genuine uncertainty, a lack of investment, you could see a bit of a slowdown in that area and you could see some impacts. We don't think they're going to be particularly significant. We're not expecting a dramatic change in the economic outlook in the UK, but that's the area we would focus on to see whether there are potentially any problems.
What sort of cyclical or recovery situations are attracting your interest?
We look at a number of cyclical and recovery situations. We think it's an area of the market where there's good valuations because investors aren't prepared generally to look through difficult periods. One sector in particular we like is the UK construction sector, which has been through a very tough period of 4 or 5 years of downturn and is now starting to come out the other end. And we see good value in a number of UK construction companies with improving order books, improving cash flows, and improving opportunities. Companies like Kier Group, Balfour Beatty. Another example might be the mining area, which has been incredibly weak, clearly with commodity prices very depressed. We've added a company called Antofagasta, which is a copper miner. We've added that in the last 6 months to the portfolio. And I think that's set for a recovery. It may take a bit longer, but I think in the medium to long term, there's good value there. So there are a number of companies where we're seeing interesting opportunities.
How important do you think dividends will be in terms of total returns this year?
Yeah, that's a very good question. Dividends are always an important part of the return from equities. I can't tell you in any one year how big a part they're going to be without knowing what the market's going to do overall. What I would say though is if you get a 4% starting yield on the market or a 5% starting yield on the companies we own, that's a good starting point for a sensible total return over the medium term. You wouldn't need much capital growth or much dividend growth on top of that 5% starting yield to get really a quite attractive return out of UK equities, particularly compared to what you can get putting the money in the bank or in bond markets. So I can't predict where we're going to be this year, but I would say that dividend is a very important part of the total return you're likely to get out of equities.